Hello, this is Craig Larson with Larson Financial Advisors for the Market Minute on June 17th, 2020. Greetings from the new Minnesota office. In fact, some of you may recognize our building from a couple of offices ago back there. So it's good to be up here in a beautiful summer day. So I just wanted to do a recap on markets since I'm long overdue since the last video. The last two videos we had talked about the market sort of tracking a pattern that was eerily similar to the four biggest bear markets of all time. Now, since we've had this big recovery, we're now past this sort of normal retracement level which would ensue. So, wave down, initial wave one, and then a retracement of about 50%. Well, we're over that level both on price and for time. So I think this sort of pattern of previous bear markets is now substantially diminished. So there's still risk out there. However, short-term and intermediate trend indicators are positive. Long-term rankings have improved, but stocks still haven't gone over above cash on the long-term ranking. So that ranking still favors money market, then bonds, and then U.S. stocks at third place, making a run for second here, trying to, but international stocks a very distant and weak sixth place out of six asset categories. So it's a time where I think a moderate approach is certainly acceptable. Good to have some growth positions in certain categories, but maybe not a pedal to the metal situation yet. We're going into a summer where we have a lot of uncertainty, and sentiment went from almost record bearishness at the end of March to now very optimistic, maybe a little too frothy. So I think maybe the market's got a little ahead of itself here, but we'll continue to watch that. So just as a reference point for year-to-date numbers, S&P 500 now is only down 3% for the year. Small cap Russell 2000, though, is down 15%. International developed markets down 11%. And then get this sector differential here. Financials still down 21% for the year, while tech is actually up 4.6%. So where you invest still makes a huge difference, with international and small cap and value stocks being very out of favor, with tech and healthcare and large growth just making a very rapid recovery, some to new highs. Okay. All right. So I wanted to do a quick recap on the bond market from back in March. There had been some sort of trouble brewing in bonds for a while with investment grade corporates, in that the lowest credit rating on the investment grades, there was a ton of really weak bonds that were probably junk, that the market, I think, finally realized in March that, wow, there's some trouble here. And investment grade bond index at one point was down 21% in just 2 weeks. And that's bonds. So if you think of 21% down in 2 weeks, now you'll understand why the Fed came in with all of this huge stimulus. I guess you could call it quantitative easing. But in addition to gobbling up huge amounts of government bonds, they've also started buying investment grade corporate and also junk bonds. And so it's actually illegal for them to do that. So they had to set up special purpose vehicles, they call them, outside entities that would do that they would fund. So they're kind of finding a way around that. But I think that had a lot to do with this big rally, is just the market perceives incredible support from the Fed. And I think the perception out there is that whenever the market's going to run into trouble, the Fed will come sailing along with trillions new dollars and save the day. We'll see how that works. So we're living in unprecedented territory, in that we had a record-setting shutdown of the economy, which triggered the record-setting stock market decline. Then we had record-setting quantitative easing and also government stimulus. So it's very difficult to make any kind of accurate prediction, because we've got no historical reference point to look at there. So still an environment where you want to be flexible, adaptive. We'll be watching things very closely. We've got our exit points in positions. So if things do take a turn for the worst, then we're ready for that. And by the way, statistically, historically, when the market has sharp dips, there's about a 50-60% chance that it'll want to go back and retest that low. So I wouldn't be too surprised if that happens in the upcoming months. But in the next video, we'll talk about some additional risk management tools that are kind of new, that are out there and interesting. In the meantime, if you have any questions about your portfolio, or if you're not a client and you'd like a second opinion and you didn't have a good strategy for this, please contact us and I'd be glad to help. So God bless all of you out there. Stay safe and healthy, and I will look forward to doing the next video soon with you. Bye-bye.